Welcome to lecture 3 of our accounting series. Today we delve into the bedrock of financial reporting, accounting concepts, convention and standards. Imagine for a moment a world where every business owner calculated their profits using their own unique set of rules. One might count a sale as soon as a contract is signed, while another might wait until the cash is physically in the bank account. Such a lack of uniformity would make it impossible for investors, creditors, or government to compare the financial performance of different companies. To prevent this chaos, the accounting profession relies on a standard language. This language is built upon a framework known as Generally Accepted Accounting Principles or GAAP. This principle acts as a constitution for financial reporting, ensuring that financial statements are not just a collection of numbers, but a reliable story of a company's profitability and solvency. As we progress through this session, keep in mind that these rules are not static laws of nature like physics. They are man made, evolving over decades to meet the complex needs of modern global businesses. Third, understand the role and evolution of accounting standards, specifically focusing on transition from Indian Accounting Standards AS to IFRS converged into Ind AS. Our goal today is to move beyond mere memorization and understand the why behind these rules. Why do we value assets at their purchase price? Why do we ignore value of a brilliant CEO on the balance sheet? These objectives will guide our exploration. To understand the specific rules, we must understand first the broad category they fall under. Accounting principles. They are often referred to as GAAP. But what exactly makes a principle generally accepted? For a rule to achieve this status, it must meet three criteria: objectivity, feasibility, and relevance. It must be based on facts, not opinions. It must be easy to apply. It must be easy to apply without excessive cost, and it must provide information that is useful to the user. But here is a question for you to reflect upon. If these principles are man made and results from human experience, are they permanent? The answer is definitive no. Accounting principles are dynamic, they are influenced by changes in the economy, new government regulations, and the shifting needs of stakeholders. For instances, as digital asset like cryptocurrency emerge, new principles must be developed to account for them. Thus, GAAP is a living framework that adapts to the environment it serves. Let us break down the key characteristics that define these principles for a postgraduate understanding. They are man made. Unlike the law of gravity, these principles are derived from social and economic practices. They are postulates born out of necessity. They are based on experiences. They reflect what has worked historically in business to prevent fraud and provide clarity. They lack universal application. While we strive for uniformity, different industries may apply these principles slightly differently based on their unique operational nature. They are dynamic. A business becomes more global and complex. The principles move towards more sophisticated methods of measurement, such as fair value accounting. Having understood the broad nature of this principle, we have now categorized them into two distinct groups, that is concept and conventions. As you can see on your screen, we classify these principles into two main pillars. On one side, we have accounting concepts, which are the fundamental assumptions or postulates. These are the must have for any set of books to be considered valid. Think of this as foundation of the building. Other side, we have accounting conventions. These are the best practices or traditions that have evolved over time to guide how we present and disclose informations. If concepts are the foundation, the conventions are the professional polish that ensures the final report is honest and prudent. Before we move on, let's do a quick recap. We have established that GAAP is the universal language of accounting, that is the man made and evolving. and that is split between foundational concepts and guiding conventions. Now, let's look at the specific concept that governs the recording of every transaction. The first and perhaps most vital concept is business entity concept. In accounting, the business is distinct legal person separate from its owner. Even in a small sole proprietorship, the owner's personal grocery bill should never appear in the business ledger. Why is this distinction so important? The answer is simple. Without it, we could never truly measure the performance of the business itself. If a business owner injects their own cash into a company, we treat it as a liability capital that the business owes back to the owner. This separation ensures that financial statements reflect the health of the enterprise, not the personal wealth of the proprietor. Next, we have the dual entity concept or dual aspect concept, which is very heart of the double entry bookkeeping system. It posits that every transaction has two-fold effect. There is always a giver and a receiver. This concept is expressed in the most famous equation in finance, that is assets is equal to liability plus capital. If a company buys a delivery van for cash, one asset, the van, increases and other asset, cash, decreases. The balance is maintained. If the company buys that van on credit, the asset increases but liability also increases. This symmetry ensures that the books are always in balance and provides a built in mechanism for error free detection. When we look at the company's balance sheet, we see long term assets like building and machinery. We record this because of the going concern concept. This concept assumes that the business will continue to operate for the foreseeable future and has neither the intention nor the necessity to shut down. Because we assume the business is going concern, we don't need to value its asset at what they would sell for today in a fire sale. Instead, we spread the cost of these assets over their useful life through depreciation. But what happens if a company is clearly heading towards bankruptcy? In that case, the going concern assumption is dropped and these assets are recorded at their net realizable value. The life of a successful business is hopefully indefinite. However, stakeholders cannot wait forever to find out if a company is making money or not. This leads us to the accounting period concept. To provide timely information, we divide the life of the business into smaller artificial time segments, usually a year. This allows for the preparation of the income statements and balance sheet at regular intervals. It enables interperiod comparison, allowing us to ask, are we doing better this year than last year? Without this period, checkups, management, and investors would be flying blind. In accounting, we only care about what we count in currency. This is the money measurement concept. Only transactions that can be expressed in monetary terms are recorded in the books of accounts. While this provides a common denominator for adding up diverse items like 10 tons of steel and 5 computers, it has a significant limitation. Think about this. Can you put a dollar value on the loyalty of a workforce or creativity of a research team? The answer is no. Consequently, these vital intangible assets are often left off the balance sheet entirely. Furthermore, this concept typically ignores changes in the purchasing power of money, such as inflation, which can sometimes lead to a distorted view of the company's real wealth. The cost concept dictates that an asset should be recorded at the price paid to acquire it, including any cost to bring it to the work condition. This is known as historical cost. Now, you might ask, if a company bought land in 1990s for $1 million and it is now worth 10 million rupees or dollar, why do we still report it at 1 million on the balance sheet? The reason is objectivity. The purchase price is a verifiable fact supported by a receipt. The current market value is often just an opinion or an estimate. By sticking to the cost, accountants ensure the financial statements are free from any biases of subjective valuations. When should a company record income? Is it when they receive the order, when they ship the goods, or when the customer finally pays the bill? According to the revenue concept, revenue is recognized only when it is earned. Generally, this happens when the legal ownership of goods is transferred or when service is rendered and the customer has legal obligations to pay. This concept prevents companies from window dressing their accounts by recording future expected sale as current income to make the business look more profitable than the actual. The matching concept is the logical partner of revenue recognition. It states that the every dollar of revenue recorded in a period, the expenses incurred to earn that specific revenue must be also recorded in the same period. If you sell a product in December, the cost of the material used to make that product must be recorded in December's income statement, even if you have paid the supplier for those materials back in October. This matching of efforts, that means expenses, with accomplishments revenue, is what allows us to calculate an accurate profit for a specific time frame. In the world of professional accounting, we have saying, in God we trust, all others must bring data. This is the essence of the verifiable objective evidence concept. Every single entry in the accounting records must be supported by a source document, be it an advice, a bank statement, or a physical contract. This ensures that the accounting are not influenced by the personal whims or biases of the accountant or management. If an auditor cannot find the paper trail for a transaction, that transaction essentially does not exist in the eyes of the law. This objectivity is what builds trust with the external stakeholders. The accrual concept is perhaps the most fundamental concept distinguishing professional accounting from simple cash bookkeeping. It dictates that income and expenses are recorded when they occur, regardless of when the cash actually changes hands. For example, if a company uses electricity in March but does not get the bill until April, the expenses must be recorded in the March accounts. Why? Because the benefit of that electricity was consumed in March. This provides a much more accurate picture of company's financial obligation and performance than simply tracking the movement of cash. We have covered 11 foundational concepts. Let's pause for a quick recap. We have seen how the business entity separates the owner from the firm and how dual aspect keeps the equation balanced. We have learned that the going concern and accounting period concept help us to deal with the element of time. We have also explained how money measurement, cost, and objective evidence provide the factual basis of accounting, while revenue matching and accrual ensures that our profit calculations are timed accurately. With these rules of the game in place, we now turn the conventions, the traditions that guide how we interpret and present these facts. While concepts are theoretical assumptions, accounting conventions are practical guidelines based on long standing customs. Provide the attitude an accountant should take when preparing financial statements. Consider this. If a concept tells you what to record, a convention tells you how to disclose it to ensure the user is not misled. There are four major conventions we need to examine: full disclosure, materiality, consistency, and conservatives. Let's look at each in detail. The convention of full disclosure requires that all material and relevant facts concerning the financial performance of a company must be fully and fairly disclosed. This goes beyond just the numbers in the ledger. For instances, if a company is currently facing a massive lawsuit by the potentially bankrupt it, that information might show up in the current balance sheet as a debt. However, under full disclosure, the company is legally and ethically required to mention this contingent liability in a footnote of the financial statement. The goal is to ensure that no investor is blindsided by hidden information. At first glance, the convention of materiality might seem to contradict full disclosure. It suggests that accountants should only focus on significant items, but significant is relative. For a multi-billion but significant is relative. For a multi-billion dollar corporation, a missing $50 stapler is immaterial. It would be a waste of resource to track it as an asset and depreciate it all over 5 years. Instead, we just expense it immediately. However, for a tiny street side kiosk, $50 might be a very material. Materiality is a matter of professional judgment. It asks, would knowing this piece of information change the decision for a reasonable investor? If the answer is yes, it is material and must be disclosed. Imagine if a company used one method to value its stock this year and completely different method next year. The profit figure would be incomparable. The convention of consistency requires that once an accounting policy or method is chosen, it should be followed consistently year after year. This doesn't mean a company can never changes its methods. However, if they do change, perhaps to better reflect the economic reality, they must disclose the changes and explain its financial impact in the notes. This allows user to make apples to apples comparison over time. The convention of conservatism, also known as policy of caution or prudence, is summed up in one phrase: anticipate no profit but provide for all possible losses. In practice, this means if you think a customer might not pay their bill, you record a loss immediately. But if you think you might win a lawsuit and get $1 million next year, you wait until the case is in hand before recording it as profit. A classic application is valuing inventory at cost or market price, whichever is lower. This ensures that financial statements don't paint an overly optimistic picture of the company's health. To recap our journey through conventions, full disclosure ensures transparency, materiality ensures we don't get bogged down to trivial details, consistency ensures our data is incomparable over time, conservatism ensures we are realistic and cautious rather than overly optimistic. Having explored both the assumptions, concept, and tradition conventions, we have the full picture of principles that govern accounting. But how do we ensure these principles are applied identically across an entire country or the world? The answer lies in the accounting standards. Accounting standards are the formal code of conduct issued by authorized body, while GAAP provides the general theory, standard provide the specific how-to manual for complex accounting issues. The primary objective of these standards are threefold: to harmonize diverse practices so that every company treats similar transactions in the same way, to ensure consistency across different period and different enterprises. Third, to ensure or improve comparability, which is essential for global investors who are deciding whether to put their money in a company in Mumbai, London, or New York. In India, the heavy lifting is done by Accounting Standard Boards ASB, which was established by the ICAI in 1977. By the early 2000s, there were 28 standards. They served India well during the initial phase of economic liberalization. However, as Indian companies began to list on foreign stock exchanges and attract global capital, a new challenge emerged. Indian standards were slightly different from the International Financial Reporting Standards, that means IFRS, used globally. In 2007, a major decision was made. India
decided not to adopt IFRS exactly as it was, but to converse with it. This led to the creation of Indian accounting standards in AS. What is the difference? Adoption would mean taking the international rules word to word. Convergence means designing Ind AS to be as close as IFRS as possible while allowing for small carves out and carves in to suit Indian legal and economic conditions. This ensures that an Indian company's balance sheet is now easily understood by a banker in Frankfurt or an investor in Tokyo. The transition to Ind AS was not done overnight, it was a phase marathon. In 2015, the Ministry of Corporate Affairs noticed the roadmap. In 2016 to 17 phase 1, it may become mandatory for large listed and unlisted companies with a net worth over 500 crores. In 2016 and 19 phase 2, it was extended to companies with a net worth over 250 crores. Today, India is as the gold standards for large scale Indian businesses. The transition has significantly boosted investor confidence because it brings a higher level of transparency and fair value measurement to the financial reporting. As we approach the end of our lecture, let's look at the comparison chart one more time. It is crucial to understand a postgraduate student that while they often work together, they have different origins. Concepts are legalist and theoretical, they are logic of accounting. If you violate the accrual concept, your profit is technically wrong. Conventions, however, are judgment based. If you decide an item is immaterial, that is a matter of professional opinion. Convention provides the prudence and consistency that allows the logic of the concept to be applied in a way that is useful to human being. You might be wondering, as a future manager or accountant, why do I need to know these definitions? The reason is that principles are the basis of financial integrity. When a company like Aaron or Satyam collapse due to accounting fraud, it is almost always because they intentionally ignored or misinterpreted this concept and conventions. Understanding the cost concept prevents you from artificially inflating asset value. Understanding revenue recognition stops you from claiming future profit today. These are not just academic definitions, they are the ethical guardians of the global financial system. How accounting standards have evolved in India, moving from the old AS to the modern, globally aligned Ind AS. Together, these elements from a robust framework, they ensure that financial statements are relevant, reliable, and most importantly, comparable across the globe. As a final thought for you to take away, if accounting is the language of business, then what we study today is a grammar. Just as you cannot write a great novel without knowing grammar, you cannot understand or manage a great business without mastering these concepts. Till then, keep learning, keep revising. Thank you.